Okay, Bill, thank you. Thanks for all your help. And this one's running?
Yes.
Okay. Ladies and gentlemen, good morning to everyone and welcome. We will call to order this regular quarterly meeting of the Lawrence County Retirement Board. Today is Tuesday, August 13, 2024. We would ask if you have a cell phone, if you'd be kind enough to put it on vibrate or silent. We'd appreciate that courtesy. We always start our meeting with the Pledge of Allegiance, and then we'd ask you to remain standing for a moment of silence. Mr. Prestipine, could you lead us in the pledge? Sure.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Just have a brief moment of silence. Thank you all. Could we have a roll call, please?
Controller Prestipine.
Here.
Treasurer Rapone.
Present.
Commissioner Sinata.
Here.
Commissioner Kennedy.
Here.
Commissioner Vogler.
Here. All 5 members of the retirement board are in attendance, so we do have a quorum. Right at the moment, we have no members of the public, but we will have 2 opportunities for public comment. And we would ask that if someone does come in and asks for that time to speak, that their comments be related to matters involving the retirement board and the pension fund. And also try to keep your time to about 5 minutes if you could. And as noted, right now, we have no members of the public in attendance. So in our packet, well, let me stop for just a moment. It's not on here, but let me see if my fellow board members have any opening concerns or remarks. Mr. Kennedy, anything? No. Mr. Rapone? Mr. Prestipine?
Nope.
And Mr. Sinata? Okay, thank you, gentlemen. We have in our packet the minutes of the June 11 meeting of this board. I'll give you time to look it over, and whenever you're ready, I could take a motion to adopt the minutes.
I'll make a motion to adopt the minutes.
I'll second. Mr. Prestipine moves and Mr. Sinata seconds for approval of the minutes. Any other concerns? If not, we'll take a roll call, please.
Controller Prestipine.
Yes.
Treasurer Rapone. Commissioner Sinata.
Yes.
Commissioner Kennedy.
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you, Vanessa.
You're welcome.
Next on the agenda, we're always pleased to have Sarah Wilson with us, regardless of whether the news is good or bad. We're always pleased to have you here. So as you begin, Sarah, just for perhaps my benefit at least, and maybe for the benefit of the others, when you get to the point where you'll be talking specifically about our fund, could you make it clear as to when the cutoff date is as far as this information you're sharing with, what's it run up to? So, okay. But I'll turn it over to you, and we look forward to your report.
Good morning. So if we look at our quarterly books, we'll go to Exhibit 2. I also put in there an updated July performance and updated numbers, but this is through 6/30. And really to kind of understand your performance, you have to understand what happened in the economy. The one thing I can say that we've really started to notice, by the time this is printed, everything's different. We have this really changing, volatile market. So when we look at it, you have to understand what happened, but then, I'll tie in some things that are going. So on page 10, when we look at U.S. real GDP growth, picked up in the second quarter with real GDP increasing at an annual rate of 2.8%, better than expected headline. And one of the things about this is that kind of really has changed. So we had a positive quarter for second quarter, but you can see it's picked up. And then we talk about what's happening with small business. And we know that we have in your portfolio an exposure to small caps and mid caps. And they have really had a tough time right now, because when we look at what's happening, they usually are the companies that tend to borrow money. And we know higher interest rates there. They've had difficulty hiring. So when you look at the bottom of there, you can see the CEO confidence is near its 10-year average. So it's basically average on what's going on. But you can see that small cap has really kind of declined a little bit, and that will be affected. It's a harder in performance when we look at that. One thing that we've seen right now is credit card and auto loan delinquency rates for younger households is growing. 50 plus has been fairly about the same. I think we're going to really start seeing auto loan delinquencies and things coming down. I think it's interesting when we see this kind of environment, we also see that, there's been a broad expansion of banks, of community banks, of regional banks. And usually they do very, very well, and especially in high interest rate environments, because they're starting to make a lot of money off of loans. But then when you start seeing delinquencies and everything, it becomes harder for them. So it'll be interesting to see what happens in the next couple of years with there. When we look at page 11, we talk about what's happening with the labor market. And we know that unemployment rate, for example, was 4.1 at the end of June, a notable increase above its 12-month low of 3.5. Then we know July unemployment came out, and we've seen that starting to go up. Unemployment edged to 4.3, its highest since 2021. So unemployment's starting to go up, and that has been a large part of the market, kind of we've seen in the last couple of weeks where the market's really had some tough days. One thing that when we look at that, you can see the leading indicator for overall labor market was down 7.7 in June, marking its worst level since April 2020 for temporary health positions. So usually in the summer, you'll see unemployment kind of lower. You can see what's going on because there's a ton of temporary positions. The kids that are working at Idlewild and Kenwood count as being employed there. So we've seen that. So that is a big change in dynamic usually. Usually you don't see the summer start dropping. So we know that everything that's starting to happen, we talk about that and we look at short-term interest rates at the bottom. This is where it becomes very interesting. Remember at the end of the quarter, we talked about last quarter, end of the year, we thought there would be about 3 cuts. Then by end of March, April, we thought they could actually up it because they still weren't getting that economic data in. Then at the end of this quarter, we thought maybe there could possibly be 3 cuts by 2024 and another 4 cuts in 2025. Just going to jump ahead a couple of weeks from the time this was printed. Now they come out and they said they'll do 2 25% cuts, they believe, in September. And then they could cut possibly 5 times. Doesn't matter if there's meetings, they can come out and do an emergency cut by the end of the year. May or may not happen, but you're getting all this data. So what happens to be able for them to do that? Remember we talked about how they raised it too fast, they cut it too fast, they raised it too fast, now we're probably gonna see them cutting it too fast. So it's never gonna be able to catch up with itself when we look at that. And we also look at the market. So yes, it's great, interest rates are going down, but at what cost? It's the cost of the consumer. Consumer can no longer afford what they're doing. So, unemployment gets higher, consumer confidence goes down, and then you start seeing for the first time, we've seen inflation has been starting to go down. It's its lowest level, and housing is finally starting to come down in pricing. That's across the board, and gasoline for a while through the second quarter had come down a little bit. So when housing comes down, usually with rates coming down, it could be more affordable. The problem when we go back and we look at it, the consumer under the age of 35 is not saving, and it doesn't have a tendency to want to go in and buy. So we're probably going to see the real estate market, not institutional real estate, but individual household real estate market start coming down in the next couple of probably 6 to 9 months. When we look at page 12, we talk about inflation. We have to remember we're a global economy, and this portfolio also has exposure. Annual inflation fell to 2.5% in the Eurozone through June, well below its peak of 10.6%. And then in the second quarter, the European Central Bank cut its key rate by 25 basis points. So when we look at the inflation, that's actually good for Europe, for international. Hopefully those small companies and mid companies will be able to start borrowing a little bit more, and we'll see some growth there. China consumer confidence, and I think this is really interesting, it is still down. They have really had a hard time post COVID recovery. They were one of the worst to recover. And we look at CPI rose just 2% from a year earlier, below expectation of 0.4%. And then recent economic growth has driven by export and investments, while household savings is at its record low. And China is a huge part of the global economy, so they're still struggling when we look at that. And that has been reflected, if you look at page 13, you can see international equities are down 0.4, international bonds are down about 0.2. The good news is for the quarter, US equities were up 3.2%. We look at, for the trailing 12 months, US equities were up 23.1. Emerging market equities, when we start to see interest rates go down, you're going to start seeing emerging market equities start to benefit. They were up 5% there. US bonds, and this is one of the reasons why we were very well diversified, US bonds just are not returning anything again. And then when we see interest rate hikes going down, that's going to be a struggle for some managers out there. And then you look at the dollar strength played a role, detracting approximately 1.4 and 1.2 percentage points from international developed and emerging market returns. So meaning that when the dollar is strong internationally, they struggle more. When the dollar is weak, we see international emerging markets do a little bit better. If we turn the page, we can go look at, I think this is interesting when we go look at what the performance is. Economic sector performance was mixed. Materials, industrials were the worst performing sectors in tepid economic data. And then we know that tech followed the way. We've got the major 7 stocks moving this. And then for July, healthcare again ended up leading the payroll. So healthcare is still strong, and gains were in construction, government, transportation, and warehousing. And that's where infrastructure really starts to do well. Materials were down, REITs were up, and then utilities were up. And then what we have to talk about, and this is really going to go, we'll talk about what happened in the last week after we go through your performance and everything. But this is very important to understand. Over the past year, growth has outperformed value more than 19 percentage points. You know, we take a little bit of a value tilt that helps you in extremely volatile markets and down markets. But what we also have is we have a handful of mega stocks absolutely running this market up and down. So it's not a broad market, it's these very concentrated market. And so when you start seeing huge sell-offs, it's because a tech company might have missed their earnings. And we look at where we are on low volatility and value and versus what's happening with them. So the momentum stocks are the Amazon, Eli Lilly's, NVIDIA. So outperformed once again small caps and mid caps and higher yielding stocks, meaning your blue chips. You like a higher yielding stock, that's where you go for safety because you get a dividend. Small cap and mid caps are where you're going to see the most growth over time. So that's why you have exposure to them there. But then we look at quarterly performance on page 15 and we talk about S&P 500 and S&P 500 equal weighted. So equal weighted is if you took all 500 stocks and equally weighted them. S&P 500 is obviously all the stocks, but really getting moved by these mega stocks. So for the quarter, the S&P 500 outperformed its equal weighted counterpart by nearly 7 percentage points. So it'd be great if you just held those stocks. You never want to do it. So you're diversified. So you really have to understand where performance is coming from. It's very difficult for these managers to outperform their benchmark. While they're still doing very well, and we'll look at those managers, you have to stand back and say, if a manager hasn't outperformed its benchmark, it's probably because of what's happening within the market. And so it's not as much of a concern. When you've got a market going like this and you've got a manager completely underperforming, then you start to get concerned. In this market, and you know, one of the things that I think is really solid is the majority of our employees are in research. So that's where we put our infrastructure and research is unbelievable. You know, last year we did over 3,000 meetings, manager meetings. We flew research analysts out to Europe to meet with managers. So really, when you look at these companies, you're never going to turn your book over and see that it's outperformed so badly, and it's because of the manager. You know, so we really are we're keeping on top of it much more now because of the volatility in the market. We look at, and then going to that, and then we'll talk about how you did it. I think this is very interesting. Go look at the bottom of page 15. So we look at the earnings growth year over year. So right now in 2023, we would have wanted to own all those mega stocks. Look at them. They had their earnings versus the S&P 500, 57% versus 4% of growth. 2024 started to drop a little bit. We saw that in the market. Apple had a hard time, 37% versus 6%. We go out and look at the estimates for 2025, 19 versus 11. So it's starting to come right back into line. And then 2026, 13% versus 9% on the earnings. So what that means is, well, these all have had this massive run up. We're going to start looking at earnings growth and what happens. They've just been able to continue. And a large part of that is just within their industries and everything while they're growing, they had a lot of cash. They did not have to go borrow. They did not have to borrow in this interest rate environment. So we're going to start seeing the S&P 500 medium stock, meaning we'll start seeing managers' performance much closer to what their current market conditions are. Are there any questions? All right, let's talk about what you did. And this is a portfolio overview. And the portfolio overview is, remember, this is as of June 30th. So it's year-to-date through June 30th. You had a net investment gain of 1.5 for the quarter and a gain of 1.4 million. Year-to-date, the fund returned 6.7 with a net investment gain of 6.4 million. Not a bad year so far through 6/30. Since inception, the fund has annualized return of 7.6 and a net investment gain of 60.8 million. So you're in really, really good shape there. Positive attribution for the quarter was U.S. equity manager Eaton Vance. We'll look at real estate managers. The real estate manager did well. Their defensive equity manager did well. And remember, those are the two that we kind of funded both from fixed income and equities. Negative was international U.S. equity manager Harding & Loevner, which jumped right back in July. We'll look at that, the value tilt, and all in your investment fees are 28 basis points. So that's great. And remember, the numbers that you see, the return is net of our fees, net of the manager fees. So it's everything. So that's a true net number. And then I did talk to Dave from Korn Ferry, and we're looking at 3 dates in September or early October. So we are working on that. It's just August is a crazy month for both of us with all the quarterly meetings and conferences. So we're going to get together a couple dates and throw them back to go do that. And I'm sure right now employees will have some questions on the market and where they are, but you're doing great. And we looked at, you were just off a little bit for the quarter, 1.5 versus 1.7. Not a concern. Year to date, you're right on there. Are there any questions so far? All right, so let's pop to page 30, and we'll go look at the performance summary there. So we look on page 30, and we're going to look at your U.S. equity composite right there. For the year-to-date, did 13.2 versus 13.6. It was a little bit off for the quarter. A large part of that was Eaton Vance, though, did very well. they were down only 3% versus 4.3, and that's where that value tilt really, really comes in, because you want to be protected in the down market. And they've done 6.4 versus 2.3%. When we go look at the global equity composite, we know global's had a tough time. Dodge and Cox was under their performance in a down market. Year to date, they've done 5.3 versus 6.2. But 1 year they've done 14.1 versus 13.9 there. Remember, Artisan has had a tough time. We look at Artisan and we think, what is going on with them at 1.3 versus 6.2? Last year, I think we talked about this, we brought them in. Last year, we brought them in this year. Last year, even though they were off by 600 basis points, their benchmark, they were the #1 performing manager in their space. It's just where they are in that. You have to give them a benchmark. You can't just sit there and feel it. So you want to narrow down the benchmark. So we're still have a lot of faith in Artisan. And then you can see your MFS low volatility global's done great, 1.6 versus 0.3 for 3 months, and year to date 7.8 versus 5.1. They've just done a great job. They've been annualized almost 10 years at 8.6%. When we look at non-US equities, we look at Harding and Lover International Small Company. They have just really struggled. Now we put in DFA Emerging Markets Core Index. There, we like them. We think they're a great company. They're going to have a little bit more exposure to the emerging markets, and they did for the quarter 5.6 versus 5.0. We look at real estate composite, and it's negative. We would assume it's negative right now, but they've done 4% annualized. Remember, we said 5.7. 5 to 7% for the next 10 years. We also know what happened in real estate. 2022, they were the only positive performing manager within the portfolio. And so everybody lined up and said, I want my money out of real estate. So I had a 5%, but I had grown to 7. I want to take it down to 5. We saw that across the board institutionally. They pay a great dividend. We know they're going to struggle a little bit on the real estate there, but TA Realty Core Property actually was positive in a down market. They were 0.2 versus 0.7. We know when interest rates get really high there, and they also have had a tough time, but they're going to, real estate is going to turn around as it always does. And remember, it's institutional. So, their basic in real estate is looking at large industrial complexes. You're no longer owning the malls. You're no longer, hotels and stuff. And after COVID, they had to really revamp. And we make sure that both your managers have very little leverage. So we always watch that there. JP Morgan Infrastructure, I think for 1 year did 11.3 versus 6.1. And since we put it in, it's annualized at 10.4%. Also really, they've done a great job for you. Defensive equity will always see in this volatile market will do well. They did 3.1 versus 2.9, Parametrics, 9.7 versus 8.9. And for the trailing 1 year, they put 14.2 versus 14.5 versus 14.9. So they're right on the market. And you're going to notice really quick that some of the 3 and 5 and 7 years are missing. We are in the process, it's not missing from there, it's just how the report's generated. We are in the process of switching over from what we call Investor Force to Paris, which is a whole new reporting software program. And it has been a nightmare for the client analysts. So when we look at that, I went back in, we've run everything, all the numbers are correct. You'll see a new report format next quarter, and it's got some better analytics there. When we turn the page, we look at US fixed income, down again. CSB Key, we put them in last year, and they, have outperformed there. For 1 year, they've done 3.5 versus 2.6. Remember, we took them in as an active manager. I think in this environment, you really want, because of your size, you can have a separate account active management, and I think that's done very well for you. And then just, we put the Fidelity US Bond Index Fund around it. It's what the bond index is there. And you can see for the first time in the trailing 12 months, you're actually getting something for your money, 5.6. But it took a long time to catch up. And then believe me, when the interest rates go down, it'll drop immediately. But it was very interesting to look at money markets. When interest rates kept going up and up, it took a long time for the money markets to catch up institutionally there. Are there any questions about performance? Well, I just want to talk a little bit about what happened last week, because we got some incredible days. I'm sure everybody was looking at it thinking, oh my goodness, what about my pension? What about my 401k? So last Monday, the US market sold off. The S&P experienced its worst day in nearly 2 years. Despite a 3% decline, the S&P is not in correction territory. Only 8.5 off of its July 16th high. So it's hit all these highs and then it just came back a little bit. But when you start seeing the Dow and everything correcting like that, you see 1,000-point days, you're like, oh my goodness, there. One of the things, it was broad-based, the sell-off. Technology led the way, small caps fared the worst. And then we know that markets came back up. So when you take out this page here, and you look at this real quick, at the end of July, you were at 1.2 million, 1.29, and you can see the performance there right on. But at the end of August, you'll get that, I think that all came to your emails this morning, you're at 1.1. So really not such a huge correction when we look at that there. Sell-off exhibiting a rough start to August, mixed earning reports from technology-related companies, Amazon, Apple, as well as Intel. On Thursday, a weak job report as well as rising jobless claims, and on Friday, so it's basically a tsunami of everything just coming up. Volatility is not uncommon in the markets, and I think this is on average, the market drops 3% 7 times a year. It has been 5% 3 times a year, and 10% once a year. So when we look at that, it's really not as much volatility as you've seen. But however, the last time the S&P fell by more than 3% was in September 13th, 2022. So you see a lot of corrections happening intraday, might not close like that there. We look at what's happened with this. We've got a couple of things going on. We know the Fed, there's some uncertainty with the Fed. I personally would be shocked to see if it gets cut 5 times by the end of the year, but I could be wrong there. And then the other thing you do have is, this is the year for us as institutional investors to be like, this is 4th year for president, it's a presidential election year. The market's just going to be very soft and smooth. It's going to be great. Well, that dynamic changed when you had a different person running. So with Harris coming in, you don't always know what her policies were. So remember, at the beginning of the year, we knew what each side was going to do. You knew where their economic stance was and everything. So this could be a change. Also with the House and the Senate, there's some interesting things. So you'll see a little bit more volatility. Usually this is a nice calm year. We could be not as nice, as calm there. So, looking forward to well diversified. I think that's the most important thing. You've got some great companies. And if you look at this sheet right here, I just want to point out one thing. If you look at Carnegie Lover International Small Cap Companies, and this is where they did 4.3 versus 3.2. And normally, I wouldn't ask you to go look at just 1 month performance. But this is where you kind of hang in with the manager and know that they've got quality instead, so they're going to survive in a very volatile market. So that's, just specific, because at the end of June, they were really down versus their benchmark. So we look at them broad-based. Going forward, I think the changes putting in infrastructure, putting in real estate, putting in defensive equity will really help where you're going. I think putting in the active manager CSV key last summer was a good idea. I know we made that decision, but I came and talked to you, it's discretionary, we can put the managers, but for that, you decided as a board too, we looked at that, there. So I think it's just kind of hang in. I know in the next 12 to 18 months, we're probably gonna see some harder years of returns. And I think it'll be interesting what the Fed does. And you never know, there. I think we will see some cuts. On a personal opinion, I hope they don't jump them, cut them too fast down, because then I think we're just gonna reel and have this happen again 2 more years down the road. And, they are still targeting that 2% inflation, so you have to sit back and think about what did you have to do to get there, and what's happened with the American consumer. And that is gonna probably see more struggle in rural areas, you're probably gonna see a little bit more delinquencies on autos, you're gonna see something on the housing market with all those credit lines, you're probably gonna see that have a real change on the consumer, and let's face it, it's gotten very expensive to buy groceries, gas. But even though this summer was the busiest summer for travel, and that's probably because it was done on plastic. So you're probably gonna see that to come back to roost a little bit, there. But there's some good news out there, and I think that when you start seeing interest rates go down, you're gonna really see your small cap and mid cap managers do very well.
Well, as always, we appreciate your very thorough and understandable presentation, and these documents are most helpful. Let me start the questions. Going back to page 22 of Exhibit 3, where at the end of June, our fund stood at 101.7 million. I guess I'm either going to ask you or Mr. Prestipine, whoever's able to answer it, or both of you, as current as possible, you know where we stand right about now,
As far as,
our value, what we have in the fund.
End of August 9th, at the end of August 9th, we were 101.3.
Okay,
So you're still ahead.
okay. And that corresponds with your understanding. So it was a slight, as of, you say August 9?
Mhm.
Okay, so it was down slightly from June 30, but not a whole heck of a lot.
No, it's up.
Oh, say that dollar number again?
101,174, okay, 100,174,000.
Yes.
And as of August 9th, it was 101,321,000.
is that what they just sent this morning to us?
Yes. So you're up.
Okay, that's good to know. So that takes care of my question. Let me see if Mr. Kennedy has questions. No? Okay, thank you, Dan. Mr. Rapone?
Yes, thank you, Thank you, Sarah, once again, very informative. You answered my one follow-up question about the education sessions going to be full. Some company here that we're going to be doing out to the employees. The one question I asked the last time we gathered was about the fifth-class counties. Do you remember that? It's okay. How many of your PA clients are fifth-class counties, and how do we all compare? Apples to apples.
Well, I think apple to apples, when I went back and looked at your PA database report, you're up here. You're probably comparing to, and then what we're gonna do is we're gonna pull out those class counties for the next PA database that we're starting to do in September, so you'll be able to see exactly where you are within those. Remember, not everybody, does, participate in it, but we get about 48 counties doing that. So I did go back and put that on there. But where you are, I would say, so you're in the top, like 90th, or, you're in the top, you're about 9%, so in the top 10% of where our counties are. You have to remember, one thing is when you compare yourself to some of our counties, some of our counties aren't as well diversified as you are, so you've done, a good job on there. And some of our counties are extremely diversified because they're hundreds of millions of dollars. So when we look at there, you're kind of leading the way. I know with my county clients, you look like all my other county clients, meaning you're all invested basically the same way on the OCIO model. So some counties have traditional, they get to pick their managers. All of the counties that I deal with are all discretionary, meaning they're in the OCIO model, and you're right there along with them.
Compared to all fifth-class counties. in PA.
Yes. And I think the PA database is gonna be really, interesting this year, because it came off of last year. And you look at how the diversified, the one thing that is different when we compare all of those counties is that I just said is traditional. So a traditional county client will pick their managers. We'll recommend 3 and they get to pick them. They also, so with having discretionary, which has done extremely well for you, remember, we get rebounds back to target, no motion. You know, if manager's not doing what it is, it doesn't take 4 board meetings to get them out. We pull them out, put an index in there, and then we'll find the right manager for you. So within there, I think, you've done very, very well. And as funding goes, you're my most funded county out of my clients.
One more question,
Of course.
and for you, Dave. Would you still say we're like 101% funded?
Yep.
101?
101.3, I believe, last report.
Thank you.
Thank you. Mr. Prestipine,
No, I'm good.
let me piggyback on what Mr. Rapone just asked you. And he referenced fifth-class counties. Of course, we're this close to becoming a sixth-class county. Unless our population shoots up in the next 5 or 6 years, that could very well happen at the next census, if I'm not mistaken. I think you have to go through 2 censuses. And if you're below the 90,000 population threshold, which we have been, it could put us into that sixth-class status, which really won't change things here all that drastically. But Mr. Rapone asked you to kind of focus on fifth-class counties. I'd be curious to see, because we're actually pretty close to a lot of sixth-class counties. There's some fifth-class counties that have, 50, 60,000 more people than we do. So maybe for next time, if you could expand that to see.
I'll see if we have, and maybe what we'll do is we can pull that out once we do the PA database report too, once we get everything in.
Okay.
This year, so we always like to put that out in November and, come out and talk about that. That is interesting that you're kind of losing there, because, it's, look at the growth Butler's had.
Well, they're-
Allegheny, Westmoreland, everybody's getting out of it.
It's Butler especially.
Really?
Washington County has gained a little bit of population. Every other county is losing.
Really? So
And,
they're not going from county to county, they're just leaving.
more people are dying than being born, for one thing. We're an older population, as you know. Butler County stands out, and it's that southern corridor down there that continues to grow, but Mercer, Venango, Beaver, ourselves, no, it's in fact, the map, if you look at the map of the whole state, Center County is growing. And then when you head west, about the only place that stands out is Butler County, as far as population growth. And ironically, and I'm mindful of the time, but if the law had not changed, we'd have been a sixth-class county right now. The old threshold used to be 95,000 people. And probably in the 15 years ago or so, there was a House member from Northumberland County, which is Sunbury, Pennsylvania, was in the same boat as us. They had dropped below 95,000 people. So this House member introduced legislation that dropped that threshold to 90,000. So he saved his county and he saved our county by doing that. But for only 20 years, because again, you have to have two censuses, and if we're below 90 for 2 consecutive censuses, then we become
Just the census, correct?
in 2020. Yeah, we're at 86,000 thereabouts. So unless we see a spike in our growth and get us up above 90, we could be facing that in the early 2030s, after the 2030 census. I'll be gone then, but these gentlemen will probably still be here. So anyhow,
I'll be here.
Well, that's good.
unless you decide I want to hear it.
Now, given all of that, has that triggered any more questions? Dan, anything
I'm
else?
thinking, am I gonna be here in 2030?
Yeah, I hope so. I hope so.
Hopefully I'm here, but not here.
Well, I hope you're still here. Any other questions, though? Yeah. Rich, anything else? Dave? And I heard you say that we are 101%
3%.
funded. Okay. Well into the black. Yeah. Sarah, do you have anything else for us?
I do. I will send out those couple of dates in September. We'll look at there and get through that on the education piece. And I would say that we'll probably do 2 sessions like we did the last time. And, you know, I'll just go over the market briefly and then we'll get Dave to kind of dig down into the actuarial stuff because that's what they really want to know. For how much I'm getting, when I'm getting it, and how does it work.
We also,
Yeah.
we also gonna offer like, how like maybe Stacy or Dave, they're just explaining how you go into retirement.
That's up to this gentleman.
You know what I mean? I think Dave will cover,
Yeah,
will cover that too.
he's got a really good one, the education piece that they do.
Very good. Any other matters of business to be brought before our board today? New business, nothing's on the table. Public comment, I'll note again that no members of the public have attended our meeting today. But let me see if there are any final concerns or comments from my colleagues or from Sarah. If not, then gentlemen, may I please have an adjournment motion?
Motion to adjourn?
Second. Thank you. All those in favor, please say aye. Aye. Opposed, the same sign. The motion carries. The meeting's adjourned. And somebody can turn off the computer. I have a question though. Are you getting emails from their company?
I am, I get it periodically.
Are you?
Yeah.
I'm not, and I'm wondering if that may have happened when when we changed the email address. That may be why I'm not getting them.
Hold on.
Yeah,
Let me check what it looks
I
like.
bet it is.
Let me check what your email, because it would
Okay.
bounce back.
Just hit end.
Oh, hit end.
And I'm
Yeah.
glad you're getting it.
Thanks.
I'm glad that
Hey,
you're
man.
getting it. Yeah, we changed the domain.